G'day guys, and welcome to another episode of the Aussie Dividend Machine. In this episode I'd like to go over the basics of investing. A lot of you watching this video may be new to investing, but where do you start? How do you know what companies to look at and what companies you might potentially want to invest in? That's what I wanted to cover in this video, so stay tuned for more. Don't forget to give the video a like and hit that subscribe button if you want to stay tuned for more investment content. Let's take a minute to understand exactly what the stock market is. When you buy a stock, you're buying a share of a company. You become a part owner. This is really important because you should know all about the company before you start purchasing some of their stocks. This includes knowing and understanding what the company does, what products they sell, and how they actually make money. A lot of this you'll already know, especially for the companies that you use or interact with on a daily basis. So how does the stock market actually work? Well, public companies, or those who are listed on the stock market, issue shares or stocks to investors. This is a form of capital raising. They issue shares at a price that is paid by an investor, and in turn the company receives that money as capital. They then use this capital to expand the business and go about their day-to-day operations. So what happens to company profits? Not all companies make a profit, but when they do, they have a few options of what to do with that money. They can, 1, reinvest in the company in a hope that it will grow further. 2, they can buy back shares. Or 3, they can pay out dividends to investors. So now you know you can invest in a company and become a part owner and have access to their profits. Okay, so you've decided you want to start investing. Let's first identify what companies you're familiar with, know about, and interact with on a daily basis. A really easy way to do that is to have a look at your phone. Have a look at the applications on your phone and try to identify which companies are available for purchase on your local stock market. For the purpose of this video, I'm going to pull up all of the Australian shares that I've currently got installed on my phone as applications. I'm going to put them up on the screen so you can see exactly what they are. Do you guys know any of these companies? Maybe you've got some of these applications installed on your phone. Now it's important to note, not all the applications installed on your phone will be public listed companies. Some might be private companies. Now private companies are not listed on stock exchanges. We'll cover this in a later video, but for now, focus on the ones that you know or can Google and find out if they're listed on your local exchange. For example, I pulled up all of the applications that are currently listed on the ASX. This is a great starting point for knowing where to invest. You should have a pretty good understanding about the applications you've got installed on your phone, what these companies do, what products they have, and how good the product actually is. The next step would be to reduce this list. Pick the top 5 companies out of all those applications installed that you think are the most useful and the best product. So what were the top applications that came up on your phone? Let me know in the comments below. And if you'd like me to go over any of these companies in detail in future videos, I'm happy to do that. Comment below and let me know which ones you'd like me to have a look at. So you've made a great start. You've identified the top 5 companies on your phone and you've made a note of them. The next step is to determine how good the companies on your list actually are. So how do you do that? Analysing the performance of companies really is a full-time job. This is something fund managers, Wall Street investors, and others are doing on a daily basis, trying to find those companies that will outperform the market. For the purpose of this video, and to get you started on your investment journey, I'm hoping to break this down into a couple of key steps. First, does the company have good increasing revenue? An example can be seen here. Second of all, what is the company's profit margin? That is, how much money do they actually retain out of their revenue after they've paid all of their expenses? Some bigger companies in highly competitive markets may only average a profit margin of 2 to 3%. This would be typical for, say, supermarkets such as Woolworths, Coles, or similar. Other companies that may operate as a monopoly, such as airports, are likely to have much higher margins, say 20% or more. Having high profit margins is an important metric. It gives the company flexibility, especially during times of hardship. If they have high profit margins and the profit drops, companies with high profit margins still are making enough money to pay dividends to shareholders or to reinvest in the company. It should be noted, however, that it is not the end-all be-all to have a high profit margin. There are really successful companies that do operate on tight margins, and they've been doing this for a number of years and continue to grow well. For the purpose of this video and to help you get started investing, I'd strongly encourage you to look at companies that do operate with a relatively high profit margin, say over 5%. This, in theory, should ensure that you won't experience any short-term shocks, especially in this current volatile market. The next important part to consider is how the company is managing its debt. Is the company heavily reliant on debt to fund its operations, or does the company have a low reliance on debt, meaning it is debt-free? Debt is not all bad. It has its place, and if used correctly, can be a great way for the company to expand its growth. However, if overutilized, debt can be a burden to a company. If, for example, interest rates rise and a company is highly leveraged, or in other words, has a lot of debt, this can have a severe impact on the company's profit margin. The next step is to look at a company's plans for future growth. This information can usually be found within the annual report. Companies will give a summary of how they intend to grow the business over the next 5 to 10 years. This may include expanding into new markets, opening new stores, or increasing the size of their operations. I'll give you two examples of companies who are already well established and companies that are looking for more future growth. Number one would be Woolworths Group, a popular supermarket chain in Australia. Woolworths already has major stores all across the country. They have most areas pretty well covered. Whilst they are still opening new stores on a regular basis, they've already done the bulk of their growth. They're covering most of the country, and their growth from now on is limited. In comparison, Transurban, which is a major infrastructure group, is a company that owns and operates toll roads across Australia and in the US. Transurban is continually expanding its roads network. Currently, here in Australia, they have many major projects under construction. These projects, once complete, will have a significant impact on the company's revenue and continue to hold their profits strong. These projects, once complete, will have a significant impact on Transurban's revenue and will aim to keep their high profit margins steady. For this reason, you could expect more growth from the Transurban share price than you would from the Woolworths share price. This is, however, subject to how many shares are on issue. If the number of shares outstanding for Transurban remains the same and they successfully complete their current infrastructure projects, you could expect their stock price to go up. Now, I just wanted to make a little note about technology companies. Some of you may have technology companies listed on your list of top apps on your phone. As an example, Afterpay is a great new technology company in Australia. Afterpay allows for buy now, pay later finance without any interest charges. Now, if you look at Afterpay's financials, you'll notice they don't actually make a profit, yet their share price continues to rise. We'll look at the reason for this in a future video. If you'd like me to look into Afterpay, let me know in the comments below, and I can do a video on that company. However, for the purpose of this video and for the purpose of your first few investments, I'd encourage you to look away from these technology companies until you have a better understanding of how the market works and why their prices are going up so much. So I hope this information's given you a good starting point about where to look with your first investments. However, some of this information, especially studying a company's financials, might be a little bit too complex or something you've never dealt with before. As you learn more about investing, you're likely to become more comfortable with this and learn more and more key statistics that reveal a quality company. However, in the beginning, you may not be so confident in your ability to analyze a share and determine whether or not it's worth purchasing. So if that's the case, what are your options from here? A great way to get started would be to look at exchange traded funds, or ETFs for short. ETFs are large funds which are run by an investment company. They have a broad range of shares that the company owns. So when you buy an ETF, you get access to a whole host of companies. The aim of an ETF is to track the growth of an index. What does this mean? This means that by purchasing a large number of shares in a variety of companies, the fund hopes to track the market return. So I'll put up on screen right now what the average market returns for the ASX has been over the last few years. Now these numbers are not too shabby. So you might ask, well, why would I want to invest in individual stocks when an ETF can provide these type of returns? Well, the answer to that is that individual stocks can provide even better returns. There is the concept of diversify versus worsify. Picking up to 10 quality stocks that you know very well that have good potential for long-term growth can produce far better returns than buying a wide variety of stocks, which may include some high performers, but will most likely also include a lot of very mediocre companies. So this is the motivation about learning more about the market, more about investing, and more about how to choose and pick those high quality companies that will deliver you the best returns over the long term. So guys, I hope this video has given you a great overview of how to start your investment journey. I hope that you learned something, and I hope you found a way to help identify what stocks to start looking at and how to go about approaching their evaluation. As I mentioned earlier in the video, if there's any shares that you'd like me to go over in detail, please comment below and let me know what I should have a look at. As always, thanks for watching, and I'll see you in the next one. Cheers.